Yeah, thanks, Tim, and thanks everyone for joining us. As Tim says, I'm Keith Cullen. I'm the founder and MD of WT Financial Group, or WTL for brevity today. Firstly, today, let's have a quick look at what the agenda is. I'm going to give you some background on WTL and then take you through what's happening in financial advice in the industry and the disruption in the industry before talking to our acquisition of Sentry Group Proprietary Limited. And looking at some peer comparisons, and if time permits, running into Q&A. For those of you that don't know WTL, we were founded in 2010, originally under the name of Spring Financial Group, and our complete focus was on building a diversified financial services offering to consumers. So we were a B2C, direct-to-consumer business with all salaried advisors. And we enjoyed great success and were profitable from our first year of operation. And our success was really founded on building a great range of assets and intellectual property around advisor education and training, as well as consumer education, and a process-driven approach to advice creation and risk management. And we also built a fabulous suite of client recruitment and digital marketing tools that we originally listed under the ticker of SFL in 2015 under the profits test. And we had a very strong dividend history, paying out around 7 million in dividends. Fast forward from there to 2017, and significant changes to legislation and regulation, education standards, and the Royal Commission all impacted considerably, not just on the industry, but on our company. And it forced the board and its shareholders to have a rethink. And we determined that we would be best placed to bite the bullet and shift our thinking from being B2C focused to being a B2B operator. And we felt this would enable us to leverage the assets and the intellectual property that we developed through our journey of building a very successful B2C operation. So this strategy saw us dispose of a number of B2C assets and scale back our fixed overhead to pivot to being predominantly B2B. Central to that pivot was our acquisition of a dealer group known as Wealth Today. And Wealth Today, like other dealer groups, provides a range of services to advisors who, rather than being salaried advisors, are independent business operators who act as authorised representatives. Those services include licensing, compliance, education and training, tech support, practice management, and business development services. And look, our primary driver for this was that in the wake of the Royal Commission, we saw what became a very rapid unravelling of the traditional vertically integrated model, where the banks had acquired all of the sizable dealer groups in the country and used them to aid their distribution of products. And I'll talk some more later or shortly to explain just what the scale of that opportunity is that this unravelling of that integrated model, vertically integrated model, has presented. When we acquired Wealth Today, it had just 42 advisors. And by leveraging the assets that we've built, that's enabled us to grow organically to 120 advisors now in just 3 years. Those advisors are across around 105 practices. We've seen significant increases in revenue, and concurrently we've managed to rationalise our cost base, and we've done further of that across the last 6 months. So what we did was we bit the bullet, and we've turned the impact of industry disruption on the company on its head and turned it away from being a burden on us to rather as capitalising on it and being one of the disruptors, and certainly one that's now presented with incredible opportunity. So it's easy when you look at the advice business in Australia at the moment and look at the headlines in the newspapers with the banks abandoning the playing field of financial advice to question why you might be investing in the space. Well, the key to this is demand for advice is growing, not diminishing. We're on the doorstep right now of the largest intergenerational wealth transfer in history in this country, with $3.5 trillion of wealth about to pass from one generation to the next over the next 20 years. And what this is doing is it's really increasing the complexity of the advice required around this wealth transfer, forcing advisors to upskill to address that complexity. The demand for more complex issues like estate and legacy planning, retirement income advice planning, for aged care advice, and of course for strategic investment advice for the recipients is all growing. And this presents enormous opportunities for companies like WTL at a time when others are abandoning the playing field. From the perspective of an individual advisor, they need the support now because of this increased complexity. They need a strong dealer group with the right infrastructure in place to help them deal with the upskilling that's required for this increased demand and the increased complexity. And this is marginalising smaller, low-cost dealer groups also, presenting further opportunity for both organic growth and transactional growth. When you look at the Royal Commission, it has had a big structural impact on the industry, and you might read of advisors leaving the industry, about banks getting out of the space, being spooked by the Royal Commission. Well, we saw this same thing in the UK after their retail distribution review. We saw consolidation, a reduction in the number of advisors. We saw certain players leave the industry altogether. And therefore, initially, we saw a downturn in value in the industry and in total revenue. But this quickly turned around in the UK. And over the last several years, as we've seen a significant growth there, averaging about 9.4% per annum, clearly well ahead of CPI. And that's the turnaround and growth of the industry as it consolidates and resets to modernise that we're taking advantage of. So quickly looking at, no, we're going to skip that slide. We're going to move on now to our acquisition of Sentry. So I talked about our success in acquiring Wealth Today and turning it into something of some reasonable scale. We're now leveraging that scale through the acquisition of our industry peer, Sentry Group. Sentry was originally founded in Perth, but it's a national dealer group today. It's been running for 17 years or 16, going on to 17 years. And it's a very transformational acquisition for WTL. Sentry has 155 advisors across 95 practices. And over the last few years, Sentry has done a terrific job in evolving and modernising its business for what the landscape looks like today. So it's a natural fit with where we've arrived at with WTL also. Their real focus has been on assisting advisors in growing their practices. And this is something that is really important on the advice landscape today. Having a look at the transaction, we are paying $7 million, which will be satisfied by 50% shares, 50% cash. And we're raising an additional, or we have raised an additional 1.5 million in cash as well to deal with integration costs and the costs of the acquisition. We've done all of this at 7.5 cents, which represented at the time we did the book build a couple of weeks ago, 25% premium to the last trade price of WTL when we went into a trading halt for the book build. And the book build within 24 hours was well oversubscribed, well more than $1 million above what we were seeking to raise. So we were delighted with the support, and I think it really underscores the value that people are seeing in how accretive this acquisition is. The acquisition will settle Monday week on the 19th, following a shareholder meeting on the 16th, which is next Friday. We've already had more than 75% of shareholders vote, so all of the resolutions will be carried with the votes that we're holding thus far. The acquisition results in 2022 revenue guidance of around 70 million and a net profit after tax guidance in excess of 2 million. So post-settlement using a 7.5% share price, it gives us a pro forma market cap of 21 million, looking at a very conservative PE ratio on that guidance of 10.5 times. Within WTL, you've got a very committed group in charge. Board and management holdings combined are some 36% of the company. This is a really highly complementary and very transformational acquisition for us. It brings terrific scale and efficiencies. The board and management team will be expanded. I'd urge you to have a look at our previous announcements for further detail on that because time doesn't permit today. We're taking significant steps to restructure our balance sheet as at the 30 June balance date we've just had, and we provided a good deal of detail in our most recent announcements on that. And this will ensure we've got a really clear runway to deliver that strong profit in FY 2022. And we're very motivated to see a return to dividends that we expect to be able to get back to after 2022. Significantly, post-acquisition, we will have around 275 advisors across 200 practices Australia-wide, and this makes us a very significant player in a new crop of independent heavyweights that are emerging in the country. So we'll just have a quick look at those, and you can see what I've been talking about here of the majors, what we call the big six, abandoning the playing field. You've seen a real transference of advisors out of that institutionalised model, with NAB and CBA, Westpac and ANZ basically disappearing altogether. AMP and IOOF, the two institutional models remaining, but collectively they're all down 54%. And you've seen the emergence of ourselves and others into this crop of the top 10 independent or non-product focused, non-product producing groups. And at 275 advisors, you'll see us, these numbers are fluid, obviously, as they move about a little bit. These numbers for our peers are all based off the latest money management report from late last year. But you'll see us emerging there in that sort of top 3, 4, 5 of the non-aligned or the non-institutionalized dealer groups. And you'll see within that crop, there's a few privately held businesses in Synchronised and in Capstone and Lifespan. And then you'll see some of our industry peers there in Sequoia, Centrepoint Alliance, Count Plus, and Eastern. What all this says is there's opportunity for further organic growth, no question, as we've demonstrated ourselves in the last couple of years, going from 40 to 120 advisors. But there's also significant opportunity both at the smaller end and this larger end for acquisitions and mergers within the industry. So I think that brings us to the end of the presentation. I promised Tim I'd keep it under 10 minutes, and I think I've managed to do that. What I'd say in concluding is that our guidance of $2 million net profit after tax, or at least $2 million of net profit after tax for FY 2022, is based on our existing revenue run rates for both Sentry and for WTL. So we're not factoring any growth in those numbers. The vast majority of that revenue is recurring or recurrent, around 90% in fact. We've worked so when you look at that 7.5 cent pro forma multiple of 10.5 times, I think it really reflects very positively for the opportunity for significant share price appreciation over the next 12 months and beyond. We've worked very hard to align ourselves to take advantage of the disruption in the industry and in fact become one of the disruptors. Demand for advice keeps growing in Australia, so with this opportunity, I think we're very well placed for the future. Thanks, Tim, and thanks everyone for joining us. If there's any questions, I'd love to answer them.
Yeah, thanks, Keith. So we are seeing a lot of advisor movement. Can you talk to, is your strategy to grow organically? Are you seeing a lot of advisors you're picking up individually, as well as looking at these larger transactions? Is that part of the strategy?
Yeah, it's a dual strategy, Tim, most definitely. It's a very fluid market. There's still advisors exiting the market that's creating consolidation at a practice level. And there's a lot of advisors that are fed up with being part of this institutionalized sales network that are really looking for their next move. And for many of them, as they're aging, it'll be their last move. So the opportunity for organic growth through having a best of breed offering, which is what we deliver with the combination of both Sentry's assets at a granular practice level and the frameworks in consumer education and advisor education and training that we've built, and the risk management framework where we're turning risk management and compliance into an asset for advisors. I think we've got the best of breed offering in the marketplace. So we're looking forward to really strong organic growth. But then there's acquisition, transactional growth, not only at that larger level, but also as these smaller operators with the low cost bases just can't compete with the demands that advisors are placing on them now.
And can you had that slide about the UK experience in 9.5% growth. Do you see that extrapolating into Australia?
Yeah, absolutely, I do. And look, we're seeing it already with asset appreciation, the asset values going up, and we're seeing it in a lot of the fees in the game being asset-based fees. That's helping drive revenue up. Just because advisors are retiring, and just because banks are exiting the market doesn't mean clients don't need advice, and doesn't mean when an advisor retires, he's not just shutting shop and handing his clients over to no one, he's selling them. So yes, this consolidation's happening, but we expect the size of the industry to continue to grow, and in fact for that growth to accelerate.
And can you talk to, post this acquisition, can you talk a little bit more about the board and management that's been brought on as well?
Yeah, I can. I skipped over that because I wanted to keep it short on time, but just at an executive level, really key, David Newman, who's the Chief Executive of Sentry, is joining us as a joint Chief Operating Officer. He'll share that responsibility with our COO, Frank Paul. David will run West Coast operations and really focus on that organic growth, the business development that he's so good at. And Frank will run the East Coast operations on a day-to-day basis and keep focused on that risk management framework that we've really perfected in helping advisors see compliance as an asset rather than a liability. Jack Standing, who's with us, will broaden his responsibilities across the group as head of advice. And then we've got Shelley Radford and Rickton Jones, respectfully head of legal and head of finance from Sentry, joining us. So it really strengthens the board, the management team. At a board level, we've got Michael Harrison joining us as a non-executive director, and he's one of Sentry's shareholders. Michael was very involved in the bringing together of the Shadforth group that was listed on the ASX and ultimately sold out to IOOF. So he's got great financial services experience. He'll be joining Guy Headley and Chris, my fellow founder, Chris Kalesas, and myself on the board. And then Rob Jones, who is also a Sentry shareholder, and again was an ex-Shadforths and involved in mergers and acquisitions with Shadforths, is joining us to head an internal advisory committee on a non-exec basis. So we're really excited about the broad management team and the depth of the skills there.
And just finally, Keith, you're confident about these 2022 numbers? I mean, you're talking about $2 million net profit after tax on a new market cap of around $20 million. I mean, at some stage that becomes a very attractive dividend yield, doesn't it?
Yeah, look, it certainly does. And when you look at the depth of ownership of the executive and the management, you can see how our interests are very aligned to shareholders. When you look at our dividend history, you can see where our intention is to take this company, and it's back to a dividend paying company. Yes, it's a big turnaround, but when you look at the size of Sentry and our ability to really leverage the cost base of bringing these two businesses together, we're super confident on it, Tim, is that we're not forecasting, a hockey stick of revenue to get us there. We're basing these numbers off where we're both at today with that recurrent revenue, and we know exactly line by line what the cost base is looking like to deliver. So yeah, we're extremely confident on that guidance that we've given.